Okay, let's continue the accounting cycle. Now we're all the way up to step 7. We're getting close to being totally done from start to finish here. So step 7 is called the closing process, and we have 3 steps for that. The first thing we have to do is we have to record all closing entries in the general journal. Then with any entry that we prepare in the journal, we obviously have to post those closing entries to the general ledger T accounts, and then we have to prepare a post-closing trial balance at the end of this. Okay, that will get us through all of the required steps of the accounting cycle. We will have one optional step left to go after this. That's something we cover in the course, but is not a part of the requirements of the accounting cycle. Okay, so let's talk a little bit about this in more detail. Basically, we have a maximum of 4 closing entries. You may have all 4 or less than that. In most cases, in the textbook problems, you will have all 4. All of the closing entries are always done at the end of the accounting period. And the purpose of closing is really to reset certain accounts to 0 to start the next accounting period. Now, what do I mean by that? So remember the matching principle. You must match revenues and expenses in the period in which they occur. So if we think about it, we're going to have to close out some of these accounts. Specifically, revenues and expenses are 2 categories we'll definitely have to take a look at. And you have to realize that in most cases, you're going to have to reset those accounts to 0, because if we didn't, then we would be confused on how much of the accounts of the revenue or the expenses were earned in that period. If we didn't close them out to 0 and start at 0 at the next period, we wouldn't have any clue. It would just be all combined and we'd never figure out the total. So you will never close out any asset, liability, or the capital account. So no cash, accounts receivable, land, building, supplies, none of those assets. No liability of any sort, any payable or unearned revenue, and we will not do anything with the owner's capital account. One of the mistakes I see students make is they close out the capital account. Well, if we do that, we're closing down our business. So we definitely are not doing that here. Okay, so let's see how this works. We're going to close out the following accounts. We're going to close out revenues, expenses, income summary, which is a new account, and I'll explain that more in a moment. And then finally, the owner's withdrawals. So those are the 4 things that we're going to have to close out here. Okay, let's talk a little bit about income summary, and we'll see how we use this. Basically, this is a new account, and it is a temporary account that's only used in the closing process. Okay, so we're never going to see it on any trial balance, any financial statement. The only place it will ever appear will be our journal and our ledger, and it will be basically we use it for closing, and that's it. So very limited use of the income summary account. And here's the kicker. You can have a debit or a credit balance for income summary, and I'll explain that more in a moment. Okay, so here's how this works. Okay, so we're first going to close out all revenues and then all expenses. And then we have to post those journal entries to the T accounts. Now, when we do this, we're going to use income summary to help us with this. So the first thing we're going to do is close out all revenues, and we're going to have to be crediting income summary for all of that. And then we have to close out all expenses, and we have to debit income summary for that. So if we end up with the balance of income summary after we post those revenues and expenses in here, the balance will be on the credit side and it will be a net income. If we ended up with a debit balance on the debit side, we would have a net loss. So let's do an illustration and see how this works. So I did a very basic thing here. Basically, I set up a service revenue account with a credit balance of $10,000. And the way that we would always close out any revenue account would be to debit each individual revenue account for its current balance and credit income summary for the total amount of all revenues. So in this case, we're going to debit service revenue. Because we do that, it's going to be zeroed out. So now it has a 0 balance on the credit side. And then we're going to credit income summary. So you can see after I debit service revenue for $10,000 and I credit income summary, Service revenue has a zero balance, and in this case is what we're looking for. And now income summary has a credit balance of $10,000, which represents total revenue. Moving on to closing out expenses. Notice I set up two expense accounts here to make it very simple. We have a supplies expense, have a debit balance of $2,000, and salaries expense account have a debit balance of $1,000. So how do we do this? So to close out all expenses, we debit income summary for the total amount of all expenses. So in this case, we know supplies expense and salary expense comes out to be $3,000. So we debit that for $3,000. And then we credit each individual expense account for its current balance. So I would credit supplies expense for $2,000 and salaries expense for $1,000. And now notice when I post those to the T accounts, supplies expense and salaries expense are now zeroed out. And that's again what we're going for here. We're closing out all expense accounts to zero to get them ready for the next accounting period. Okay, let's look at our income summary T account here. You can see that from before we had a credit of $10,000, which represented total revenue. And now we have a debit posted there as a total amount of $3,000. So that represents total expense. So obviously $10,000 on the credit side, subtract out $3,000 on the debit side, and we have a net income or a credit balance in income summary of $7,000. Now, why are we doing all this in addition to closing these accounts out? Well, we have something that we have to resolve. Remember back in step 6B of the accounting cycle when we prepared the statement of owner's equity, we got the new ending balance of the owner's capital account. Well, when we close out income summary now in the next journal entry, next closing entry, we have to transfer either net income or net loss to the owner's capital account. Because remember, we need to have our general ledger T accounts for the capital account match exactly what our ending balance of the statement of owner's equity represents it needs to be. So in this case, when you have two possible scenarios, letter A is what we actually have. Please know that letter B is a separate, just totally made up illustration here. So letter A, income summary has a credit balance, which we had of $7,000. So we would have to close that out. We'd have to do the opposite of that and debit income summary for $7,000. And then credit the owner's capital account, because think about it. If you have net income, what's going to happen to capital? It's going to increase because on the statement of owner's equity, we added it in. So that's how you would close out income summary if it had a credit balance. Now again, this separate, totally made up illustration, letter B here, what if we had income summary has a debit balance of $12,000? Well, think about it. If you have a net loss, you have to subtract from the owner's capital account on the statement of owner's equity. So in this case, to close it out, we'd have to debit the decurrent capital and credit income summary. So really what you're looking for here is to get at really close out revenues, expenses. You close those out to the income summary account and then immediately close out the income summary is either as an increase to capital by crediting it or a decrease to capital by debiting it. Either have a net income or a net loss. The last closing entry would be to close out the owner's withdrawals, and this is pretty basic here. So what you would do here would be to debit the capital and reduce the capital account if you had a $500 balance in withdrawals. And remember, if you have an owner's withdrawals, you subtract on the statement of owner's equity, and it causes the owner's capital to decrease. So we debit the capital account for the amount of withdrawals, and then we simply credit the amount of the withdrawals to close it out. So this concludes the lecture portion of this video. We'll head over to our problem illustration to see how we close out the accounting cycle from start to finish problem.